overnight, prices were marked down very, very heavily. Now, I would suggest that there is some indigestion, if you like, in the Shanghai futures market, Shanghai Gold Futures Exchange overnight. We've seen this a few times during Shanghai trading hours. So that indigestion was continuing, and it drove down gold and silver quite hard. But then what happens this afternoon our time, sort of mid-morning your time? Suddenly it rallies, and as I speak, I see gold, having been down about 2%, is now up 1.4%. I mean, it's a swing of $100 on the upside. Now, this sort of thing, I guess, we don't know until we see tomorrow, but I guess on not much volume, is indicative of a squeeze on the swaps. I think they are being very, very badly squeezed.
A sharp drop in gold and silver prices during overnight trading in the Shanghai futures market, which they attribute to some market instability or indigestion. However, later in the day, prices quickly rebounded. Gold swung by about $100, going from a 2% loss to a 1.4% gain. Alasdair Macleod suggests that this sudden rally, likely on low trading volume, points to a short squeeze on the swap dealers, who may face significant pressure. The speaker, Alasdair Macleod, a well-known financial analyst and commentator, explains that recent gold market liquidity came largely from central banks leasing their gold. This was evident when bullion banks withdrew significant amounts of gold from the Bank of England to profit from an interest rate arbitrage between gold lease rates and futures. However, that leasing activity has stopped, and gold stocks in COMEX warehouses are declining. While official vault data still shows decent holdings, most gold is already owned, meaning it's unavailable as liquidity. The speaker believes available liquidity is much lower than reported, possibly only in the hundreds of tons. This is concerning given the continued strong gold demand from China and other East Asian countries. Alasdair explains that the LBMA, or the Bank of England, doesn't directly control gold transfers across the Atlantic. If a bank leases gold, it legally owns it during the lease term and can rehypothecate it, using it as collateral in other deals. Market opportunities, not restrictions, drive gold flows. If gold becomes scarce in London, lease rates would rise, potentially attracting gold back. While Bank of England vault holdings have declined slightly, LBMA vaults have increased somewhat. However, these figures only include vaults within London's M25 area and don't reflect global storage, so changes in local vault levels shouldn't be misinterpreted. Let's dive into the video for more insights. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
The liquidity has very much come from leasing, central bank, leasing of central bank gold. I mean, that was clear, and it was proved by the fact that bullion banks were queuing up to take gold out of the Bank of England vaults. I mean, these are banks which have accounts with the Bank of England. So it's possible for them to store some of their gold there, but they would tend not to. Therefore, at least a large amount of the gold that came out of the Bank of England was effectively leased gold, and it was taken by bullion banks who were benefiting, if you like, from the spread between futures, which were trading at a huge rate, interest rate premium. By interest rate, I mean compared with the gold lease rate. It was a simple interest rate arbitrage. Now, that has now stopped, and if you look at the COMEX warehouse gold stocks, they've now begun to decline. So that process is over. Furthermore, it was only week before last, I was in London, visiting someone in Throgmorton Street, behind the Bank of England. The doors were firmly shut. There was nothing going in or out. So I think that process is over. But it does raise the question, quite rightly, that how much liquidity is actually left within the system here, because we get vault reports from LBMA authorized vaults, as it were, and they have declined a little bit. but not hugely. But most of the gold there is owned by someone, as opposed to being, if you like, the liquidity for the bullion bank. And this is very important, given that the demand from China and other East Asian nations, seem to be continuing apace. They're continuing to get hold of virtually every ton of gold that becomes available. So, yeah, the liquidity situation I don't see really improving. The first question as to whether the LBMA and the Bank of England refuse to send any gold over to the other side of the Atlantic, I don't think that's quite the way it works. Basically, if you have gold or you have leased some gold and the opportunity is there, that is what drives the move over. It's actually got nothing to do with the LBMA, so long as the members of the LBMA behave within its rules and regulations. As far as the Bank of England is concerned, there is a problem because if you lease gold, then that gold is your property over the duration of the lease. And it could be that if you lease gold, say for, let's say, 5 years or something like that, which, not unusual, I would suggest, then you can pass that gold on to other people, rehypothecate it. Because, why do you have gold? You have gold basically as a bank to use as collateral, to collateralize deals. So I think from both the LBMA and the Bank of England's point of view, they're rather limited in terms of what they can do to discourage gold from flowing across the Atlantic. The market would probably do it, if you like, insofar as if there is a shortage of gold in London, then the lease rate should rise. And that might generate a bit of interest, if you like, to get gold back. And if you look at the last vaulting figures, I think I'm right in saying that the Bank of England numbers were down a little bit, but the LBMA numbers were up a little bit. Now, it's not the total thing, because the LBMA vaults, which are recorded, are vaults within the M25, which is the circular motorway that goes around London. There are other vaults outside, I guess. And also, of course, we've got other vaults in other parts of the world, particularly places like Switzerland and so on. So, this is just part of the whole situation, as it were. And I think it would be a mistake to read too much into fault moves, if you like, changes in faulting levels in London and also in the Bank of England.
While U.S. pension funds and insurance companies, including offshore ones, buy assets to match their liabilities, heavy selling pressure still drives prices down and yields up. Although tensions eased after Scott Bessent negotiated with China, underlying problems remain. The main issue is a massive global credit bubble, the largest in history, fueled by excessive debt. The speaker compares today's situation to the 1929 crash, warning that rising interest rates and protectionist trade policies, like Trump's tariffs, are repeating dangerous historical patterns. Although Bessent has softened some impacts, China ultimately outmaneuvered the U.S. in trade talks. The result has been stronger regional cooperation in Asia, with countries like Japan, South Korea, and ASEAN nations aligning with China in free trade agreements, reducing reliance on unpredictable U.S. policies. Alasdair suggests that bond markets are signaling higher interest rates ahead. Foreign investors, who hold a massive amount of U.S. dollars and debt, far more than the size of the U.S. economy, are starting to sell dollars due to concerns about the growing deficit, slower global growth, and trade tensions. Because the U.S. is in a debt trap, meaning it can't generate enough revenue to sustain its debt, rising bond yields could worsen the problem. The speaker warns that U.S. bond yields might rise to very high levels, similar to what happened in the UK in the 1970s, creating a significant challenge for policymakers like Scott Bessent to manage. Now, let's have a look back at the interview.
Good question. I mean, they're bought in the market by presumably U.S. pension funds and U.S. insurance companies. They are being bought, let us say, also by offshore insurance companies. I mean, places like the Cayman Islands have a lot of captive insurance businesses, which are American in terms of their underlying liabilities. So they would buy them to match their liabilities. But of course, if you've got sellers in the market, if the price is driven by sellers, then the prices are going to fall. In other words, the yields rise. I would say, however, that after the initial scare from the Independence Day on April the 2nd, and particularly since Scott Bessent actually took control over the matter and met the Chinese in Switzerland. Things have calmed down quite a lot, which I think is good. It really is. I mean, Scott Bessent, I think, is, if you like, the control mechanism on some of the more wilder things coming out of the president, which is great. I think that's very, very good. But it doesn't actually change the underlying problem. Probably what it does is it changes the timing of things. I mean, for example, we've seen gold sell off over the last few weeks, really since it rose up to that 3,500 level. And in declining, you could argue that that decline is because the pressure, if you like, on the whole system, the whole financial system, has been relieved somewhat by Scott Bessent coming to a more sensible agreement with the Chinese over tariffs. But the dynamics of the situation are still extremely poor. I mean, basically what we have is, this is something that so few people actually understand, is we've got this credit bubble. It's the largest credit bubble in history. If you have difficulty trying to understand that, just look at the debt side, because credit equals debt, always. You look at the amount of debt around, and the amount of debt which is bad debt, particularly as interest rates tend to rise. Now, I know everybody's saying it's going to fall, but that's another Keynesian bit of rubbish. You can see that this bubble is ripe to pop. And I think we've said this, to your audience before, that the situation in many senses is very similar to 1929. You had a credit bubble fueled, if you like, in the late 1920s, the roaring 20s. And we have Trump's tariffs. Now, fortunately, Scott Bessent has been taking the worst of that out. It was the Chinese. The Chinese actually, I mean, okay, they don't like to see tariffs. I can certainly understand that. But actually, their exports elsewhere are considerably more important to them than exports in America. They have deliberately moved away from a reliance on sales of Chinese goods into America. So, yeah, it hurts a bit, but this is why they were quite happy to raise tariffs. Every time Trump decided it was going to be 140%, I mean, they would raise them as well. And, which basically meant there was going to be no trade. I think you might find that there are going to be further problems, not necessarily just with China, but elsewhere. And of course, the other thing that is done is it's basically united the ASEAN nations, all the East Asian nations, like Thailand and Vietnam and Cambodia and even Myanmar and so on and so forth, into a trade agreement. Oh, and also, incidentally, Japan and South Korea into a trade agreement with China. They know that they're far better actually trading with each other than trying to trade with the lunatic policies coming out of America. So it's actually strengthened China's hand in the geopolitical sense enormously, which I think, this wasn't a policy that was sensibly thought through by the US government. Well, I think what the bond markets are telling us is that rates are going higher. I mean, and the reason it goes higher is you've got to look at it from the foreigner's point of view. A foreigner, let's say, buying US Treasury debt, he'll be looking at the supply. Not only has he got to find, is he being asked to refinance some of the debt that he holds as it's coming up to maturity, but also he looks at that $2 trillion-ish deficit. He looks at the prospects for America. He might take the view that it's going to be more than $2 trillion, and not only that, but he's probably overweight in dollars anyway. I mean, when you look at the US Treasury's tick numbers, which they call the Treasury International Capital Statistics, Foreigners own something like 40 trillion of currency in debt. 40 trillion. That compares with a nominal GDP of less than 30 trillion. They are horribly, horribly overweight in dollars. And if the global economy is slowing, whether it's China's economy slowing, which some people would say is the case, but trade certainly is being jumped on by these tariffs. Do you really need all these dollars? The answer is probably not. We have a situation, I think, where you have sellers of dollars from abroad for a variety of reasons, which raises the question, at what level are they likely to become investors again? And that's very, very difficult to see because with America, in effect, in a debt trap, and the definition of a debt trap is that it doesn't have the revenue income in order to sustain the level of debt it has. Under those circumstances, you find that interest rates and bond yields start rising. When we had to issue, in the throes of a recession, the government had to issue 3 gilts, in other words, our UK government bonds, with yields of 15%, 15.25%, and 15.5%. Now, I see no reason why US dollar yields won't rise towards that level. And this is Scott Bessent's big headache. How is he going to keep this thing under control?
The global financial system faces significant challenges, from tightening gold liquidity and shifting trade dynamics to an unprecedented credit bubble and rising US bond yields. These factors highlight growing risks in markets and economies worldwide, signaling that investors and policymakers must navigate an increasingly complex and unstable environment. How might reduced gold liquidity impact global financial stability and investor behavior? What strategies could policymakers use to manage rising U.S. bond yields without triggering a debt crisis? We welcome your insights in the comments section below. If you found this content valuable, don't hesitate to give it a thumbs up and don't forget to subscribe to stay informed. Thank you for joining us on this journey.